Hello and welcome to my video presentation on my financial plan for the Hernandez family. What I thought I would do is basically just walk you through the financial plan that I put together and describe the different components of that plan, talk about some of the recommendations we made, why we made them, and then some of the alternatives that we considered. So um, as far as the financial plan is concerned, we start off by just kind of summarizing some of the strengths and weaknesses that we found with the Hernandez family. Some of the strengths that we found were that they have a significant amount of retirement assets. They have done very well in their business and have amassed a good amount of assets. They've also clearly defined some very specific goals as to what it is that they want to accomplish in as far as some of their gifting and strategies like that. So those are two strengths that we found. While uncovering those strengths, we did also uncover a lot of opportunities as well, and some vulnerabilities, things that might stand in the way of accomplishing their goals. So some of the opportunities that we found were some estate protection opportunities. What I mean by that is some planning to gift properly, to reduce estate potential estate taxes, things along those lines. Another opportunity we found was insurance and liability issues. While there are a lot of insurance methods in place right now, we did see some shortfalls there that could potentially be increased. Um, Another opportunity that we found was there's a significant amount of portfolio concentration. Most of their assets were amassed inside of Dario's business, and that's where they remain. So that is certainly a vulnerability. Um, and with that, it comes in, investment allocation. Again, we have a concentrated portfolio. There's not a significant amount of investment allocation there either. And the final opportunity that we uncovered was some tax management strategies, and that's something that we'll dive into all these things in more thorough detail. So the second part of my plan was my engagement letter, and basically what this letter is intended to do is set a clear path as to what this relationship is intended to accomplish, and specifically who has what responsibilities, how long is this relationship going to last, and so on and so forth. Um, so that's what that portion of the plan is intended to do. Um, we sat down and did a pretty thorough analysis of the cash flow situation for their family. What we found was, they actually have a pretty significant amount of discretionary income, a lot more than what most families typically tend to have. So that would actually probably be another financial strength. So moving on to the next portion. I'd like to just kind of explain, the financial planning process and kind of the different phases and steps that we'd like to explore with you. The first part is defining the relationship. This is where we basically just discuss, how we're compensated, setting expectations as to roles during the financial process, and discuss how decisions will be made moving forward. So the next phase is the gathering the information portion. And this is where we sit down with you and we sit down and get tax returns together, financial statements, any estate planning documents that you have in place. We get all these things together and we just start to analyze those. So which moves us on to the next portion, which is analyzing the current financial status. So we look at the strengths and weaknesses and preparing or making our recommendations. Next portion is we move on to develop and communicate the recommendations. Once we've determined the financial status and create a plan, it's customized with recommendations based on your needs, your needs, goals, and objectives. So we'd like to meet with you and discuss recommendations for various opportunities that we have in order to meet these needs and objectives. The next portion is we'll implement the recommendations, and here I will sit down and assist you with implementing any recommendations that we made. Coordinate with other people that we're working with, that are more specialized in various areas. And after that, it's important not to neglect the plan that we've put together, and that we continuously monitor your financial status, monitor how our plan is working, any changes that need to be implemented to adapt to that. So So some of the assumptions that we used in putting together this plan, inflation is one of the primary assumptions. We used a general inflation rate of 3%, which is a little bit higher than what the government targets as their key or target inflation rate. But that's we like to err on the side of caution there. As far as college inflation is concerned, we used a 6% inflation rate for that. The pre-retirement expected investment return, we used 8% for that. The post-retirement expected return, we were a little bit more conservative. Once in retirement, we used 5% for that. And then for college funding, the expected rate of return is 7%. And we use a little bit more conservative rate of return just because of the shorter time horizon there. Dario's inflation income per year, we used a 5% inflation rate for that. Anna's income inflation, we used 5% of that as well. Dario's life expectancy, we used 82.7. Anna's, we used 86.5. And those were some tables that we found on a government website. So what we did is, based on the discussions that we have had, we basically just documented some of the specific goals that you had, mentioned that you would want us to address. And so we'd like to address those first. After we touch on those points, what we did is we moved on to, again, some of the opportunities that we found, and strategies that we'd use to potentially implement those if we agree on that way forward. So some of the goals. Explore some strategies to assume responsibility over property and personal affairs for Lucia. Protect the portfolio of bonds that are invested in treasury bonds from rising interest rates. Invest the remaining portfolio in a way that will maximize long-term returns. Withdraw the balance of the 401k plan at retirement and the potential consequences of doing so. Increase retirement savings on a tax-advantaged basis. Different plans available through Anna and Dario through work. Dario was a little bit more complicated because we were looking for something on a tax-deferred basis without benefiting other rank-and-file employees, but also without reducing its current compensation. We wanted to arrange a 401k plan in a way that would maximize flexibility in taking distributions after retirement, and begin phasing out air technologies by age 70 and minimize the risk of the successors failing to pay his benefits due without reducing his current compensation. Make arrangements to sell the business of Dario because after he becomes deceased at retirement. Provide a purchaser for Dario's interest in the business without requiring Wendell to contribute a significant cash outlay, and create a method of valuation to ensure fair compensation. Consider the retirement plan distribution options available to Anna, available to her inside her retirement plan, to her surviving beneficiaries when she becomes deceased. Determine how earned income will affect Anna's Social Security benefit at her retirement age. Minimize the estate taxes due. Provide Anna with lifetime income and access to principal if required. Ensure any of Dario's remaining assets after he and Anna become deceased pass on to their grandchildren, not allowing Anna the ability to make any changes to the plan, and vice versa. Gift $1 million to charity. Be able to receive income from the property donated during their lifetime, and allow property to pass to the charity at the death, and receive a tax deduction in the year donated. Consider a trust that's flexible, that would accept more assets if warranted, and that would provide income that would be hedged against inflation. Begin giving gifts to children and grandchildren without creating a tax liability or using up lifetime exemptions. And allow children to enjoy their gifts now, and allow grandchildren to enjoy their gifts at their age of majority. Begin funding the grandchildren's college education. Discuss implications of downsizing their home, any applicable tax gains that would be involved with that. Evaluate how to transfer commercial real estate portfolio to your children over the next few years while receiving no consideration for the transfer, and minimize tax liabilities. Implications of land ownership in other states for purposes of probate, and how it would keep the family for 7 more years in anticipation of more appreciation. And consider a plan that would allow Emilio to purchase the land on an installment sale while continuing to maintain control of the sale. Also, payments at Dario's death would be canceled. So So again, we had some recommendations that are based on your goals, and we'll touch on those first. And then we had some additional recommendations that were based on some of the areas of opportunities that we found. So first, we'll start off with some of the recommendations based on goals. So the first one was to explore strategies to assume responsibility over property and personal affairs of Lucia. So you've shared that Lucia is getting to a point where actually she already has gotten to a point where she has been declared, incompetent. And so you're at a point where you would like to try to become more involved with her financial, affairs and take control over those things. So the good news is that there is a way that you can still do that. The bad news is that now that she's already been declared incompetent, it's a little bit more tricky in order to do that. So we actually would have to go through the legal system to get, the court's permission to take over for her because she has been declared incompetent. It's really for her protection because she doesn't have the wherewithal to make the assertion whether or not she wants to give up that right anymore. And so it needs to be, determined that, it's in her best interest. And so what you would need is a licensed professional to essentially, prove that she is incompetent, and then have, the court basically, give you the responsibility for that. So typically what somebody would want to do to prevent this type of situation is put together, a power of attorney for both healthcare and property. You'd want a durable power of attorney so that couldn't be revoked as long as you had somebody that trusted as your power of attorney. This would allow you to, during their lifetime, once they become incompetent, be able to handle those types of affairs for them. So, that is something that you can still, again, take care of now. You may want to consider other, other areas, other relationships that you have that you may want to try to prevent this from happening in the future. So. That's the first topic we want to discuss. The second is to protect their portfolio of bonds that are invested primarily in treasury bonds from rising interest rates. So right now, that portfolio is invested in long-term treasury bonds. And essentially, the way that bonds and interest rates interact, they do the opposite of one another. So when interest rates go up, the price of a bond tends to go down. The reason for that is because if you're getting paid 5% to own a bond, and 6 months later, the guy down the street is offering the same bond, but he's willing to pay 7%, your bond is no longer as attractive. So, people will be not willing to pay you as much for your bond at that point because, again, his isn't going to pay a higher rate. So you're going to get less for your bond, hence the price is going down. So there are some things that you can do to protect that portfolio. One of the things is replace it with a shorter maturity. The reason that works is because if you have the shorter your maturity, the less length of time that you're obligated to stay in that bond. So shorter maturity means it's not going to, the price won't move as much. You can replace with a higher yielding corporate bond. And those tend to be less sensitive to interest rate changes. Now, while this is less sensitive to interest rate changes, it does carry higher credit risk. And so while you have a treasury bond, you don't have any credit risk. If you own a corporate bond, while the price might not be as sensitive to rising rates, it does carry a different type of risk, which is credit risk. You can replace your treasury bond with a treasury inflation protected bond. Now, those types of bonds are actually indexed for inflation. So when, in a rising interest rate environment, inflation tends to be increasing at the same time. And so, typically in that type of environment, a bond that's indexed to inflation will perform better. And finally, probably the most effective way to hedge against losing principal value would be just to replace it with cash and cash equivalents. While you won't see any growth from the account, you won't, lose principal value either. So, because you stated you're seeking alternatives that protect against loss of principal, we would recommend, you would replace it with shorter maturities, tips, and cash equivalents. You had mentioned that principal protection is your biggest priority. And so some of those options don't necessarily, they might actually protect you against, rising rates, but they don't necessarily guarantee any type of principal protection. And so, we want to get as close to that as possible. And one way of doing that is cash equivalents, and shorter maturities, as long as you hold those bonds till they mature. So the next topic was invest the remaining portfolio in a way that will maximize long-term returns. So the desire to maximize your returns in your brokerage account would typically lead to a discussion about increasing exposure to emerging markets, frontier markets, taking higher risk essentially. However, um, we would caution you in increasing the amount of risk in your portfolio at this point in your life. And the reason that we would recommend not adding more exposure to higher risk right now is just because of the concentration of the rest of your portfolio in the business, and some of the aggressive goals that you have on gifting, income that you want to have, so on and so forth. So we could tell you how to maximize long-term returns in that portfolio. However, we feel that it would be in your best interest to remain somewhat moderately conservative with those balances. Um, for example, most retirees rely on about 80% of their former income during retirement. Right now, if you take 80% of your current income being about $900,000, it comes out to about $700,000. So you assume a 4% inflation rate, and fast forward to your target retirement date, you're going to need about $18 million in today's dollars to fund your retirement, not accounting for future inflation, expected investment returns on retirement, and some of the gifting that you had mentioned that you want to do as well. So your current net worth is about $25 million. A significant amount of it is concentrated in a few areas. Again, being that we are going to require most of what your current net worth is just to fund your retirement, increasing risk in your portfolio at this point is something that we would not necessarily advise doing. The next topic we wanted to cover was withdrawing the 401k balances at retirement, potential consequences of doing so. Because a significant amount of the retirement planning is tax management, we always are looking for ways to minimize those consequences. So essentially, all the balances inside of your 401k plans have not been taxed, meaning that as soon as you pull them out of the plan, they become taxable. So the way that they're taxed is typically as ordinary income. Now, Dario's situation is a little bit different because he has some net unrealized appreciation. I can discuss that a little bit more thoroughly, but typically when you pull the money out of the account, it's going to be 100% taxable. It'll be added to your basically what your ordinary earnings were for that year, and taxed essentially at that rate. So what we like to do is try to take income from various sources, some taxable, some not taxable, and use that to create a strategy that will kind of manage our tax bracket a little bit better, and not pay too much Uncle Sam, essentially. So we try to come up with a strategy that would incorporate doing both. But essentially, the consequence of taking money out of your 401k plan increases your income for the year. 100% of those dollars are taxable. So the next topic is increase your retirement savings on a tax-deferred basis. Well, plans available to Anna through her work. Anna's taking advantage of her 401k plan, which is great. However, because of her age, she can actually contribute up to about $23,000 per year. Right now, she's only contributing about $7,500. So we thought that one great opportunity for her would be to essentially just max out her contributions. You look at your amount of discretionary income, which is about $400,000 a year. And that's money you're not spending. We might as well put that away while you have the opportunity to, and grow that money on a tax-deferred basis. Plans available through Dario, through his work. Again, you were a little bit more specific about what you wanted here. You wanted a tax-deferred basis, not benefiting other rank-and-file employees, without reducing current compensation, without risk of the successors failing to pay benefits due. So Dario is currently maxing out his 401k contributions, which is a good start. Because of his position within the firm, though, and the other qualifications you had for deferring, income, it's a little bit more complex. One method, it's called a non-qualified deferred compensation plan, it can either defer current compensation, which you said you didn't want to do, or it can create income during retirement. In order to use this method, um, you would have to essentially rely on whoever the successor is of the organization to follow through on their promise to pay you. It's basically it's a promissory note that they're making to you. One of the risks that you carry, being that it's a promissory note, is simply that they'll fail to pay. There is no guarantee that they'll pay. There is not necessarily any money put aside for you. There can be, and there are actually some consequences of doing that as well. But typically, there is no specific promise to pay or guarantee that you will get that income. So that is a risk that would come along with that. We thought that being that your relationship with your business partner, one good way of not guaranteeing that you'll get that income, but increasing the likelihood that you'll receive it is basing this plan on something that is tied to his compensation as well. Being that he has a 10% ownership stake in the company and his ownership is in the form of stock, if you can have a plan that basically would pay you in the form of stock too, essentially it would impact him negatively if it was if he was to try to do something to prevent you from getting those retirement assets. So we thought that a phantom stock plan would be a good way of doing that. The reason we chose a phantom stock plan is because it's a closely held organization, and issuing actual shares of stock might be costly. It might pose as a problem. The way that a phantom stock plan works is that there's actually no real shares issued. Hence the phantom stock. Basically, this money is set aside in an account, and it grows with the price of the stock, and it also receives dividends like the stock would receive. And once you are at the point that you want to retire, you can sell those shares, to back to the company or whoever however you want to arrange to do that. So, one of the biggest risks again doing this is you already own a lot of stock in this company, and that was one of our concerns is that you have a significant amount of concentration already there. However, we feel that the risk of not being paid the promissory note is more significant than the risk of the stock value not growing. So that would be our recommendation for that. The next topic is arranging your 401k plan in a way that would maximize flexibility, taking distributions after retirements. There are options here. You can leave the money in the 401k plan. 401k plans tend to be costly. You have several layers of management going on there, and you also have very restrictive investment options. So you tend to have your performance tends to lag a little bit. When you want to do distribution, you have to go to the 401k plan to get it. It can take a little bit longer. One thing that you can do is roll the balances into an IRA. If you roll it into an IRA, you have a little bit more control, actually a lot more control over what you invest in. And you can also do distributions much more readily by you can link it to your account, set up an automatic distribution, and it can go through the same day oftentimes. So, if you were to roll your 401k balances into an IRA, it wouldn't cause a taxable event. It would give you a lot more flexibility with your balances. So the next topic are make arrangements to sell the business if Daria becomes deceased before retirement without requiring a significant cash outlay on Wendell's part, and create a fair method of valuation. This could most effectively be achieved by creating a buy-sell agreement between you and Wendell. This agreement is obtained through purchasing essentially life insurance on the lives of each other, equal to your stake. So the beneficiary would be agreed upon in advance, and typically would include your family and the business and other owners. It's entirely up to you, how you want to set that up. You can also have the business pay the premiums, and one way of making that a fair arrangement would be to have the business pay the premiums and then have the business be a beneficiary for whatever portion of premiums they have paid. So basically the business gets paid back for the premiums they've paid. So some things to consider here. Dario had mentioned that his health wasn't the greatest. The cost of insuring his life and considering he's the biggest shareholder, that might be very costly. However, when it comes to creating liquidity, when you need to sell such a big stake of the business when there may not be other buyers, etc., it may still be the best option for you. So, while we can't say this is the best way to go forward, we would certainly inquire about, rates and terms, things like that, and see if that would be a good way to go forward. The next topic is determine how earned income will affect Anna's Social Security benefit at her full retirement age. This is kind of a tricky one. Good news is once you're at your full retirement age, you're not really restricted on what income you can take. I mean, however, if you decide to take it before your full retirement age and you want to take earned income, then there will be some potential consequences. If you earn over a certain amount, then basically your benefit gets reduced $1 for every two or $1 for every three. It is a table that you can, based on your income and age, etc. But basically, the more income you earn, you're kind of treading water a little bit because you earn more income, you're getting a smaller benefit. You might as well earn less income and continue to collect your benefit, over just unless you just enjoy the work you're doing. So one important note is that Dario should file for his benefits as soon as he reaches his full retirement age, and then suspend them, until he turns the age 70 when he was discussing retiring. This will allow him to, it'll allow his benefit to continue to grow while he continues to work, and basically while he defers that benefit. So the next topic was consider a retirement plan distribution option that would be available to Anna during her retirement and for her surviving beneficiaries when she becomes deceased. Anna has several options available for her distributions for retirement plans during her retirement. As stated before, we would first advise her to roll her plan into an IRA. Once the transfer rollover has taken place, she's already reached the age of 59 and a half, so she can begin to take distributions immediately without any type of penalty. Now remember that those distributions are taxable. But however, these distributions are a pre-tax plan. It'll be fully taxable, reportable as ordinary income when she takes them. So in the year following when Anna reaches the age of 70 and a half, she'll be required to take an annual distribution that's based on a table provided by the IRS. And essentially what the IRS is doing is requiring you to take the money out of the plan so you will eventually be taxed on them. They don't want you to continue to leave them in the plan and then gift them to somebody else, once you become deceased, and let them continue to, reap that benefit. So they will require you to eventually take the money out of the plan. So as far as who inherits the money and how that's inherited, the rules surrounding IRA balances that are inherited, it largely depends on who inherits it, their age, and Anna's age when she becomes deceased. If she were to leave the balance to her spouse, gives her the most flexibility because he could just take the balance and put it in his IRA as if they were his own. He wouldn't be required to do distributions until he became 70 and a half as well. He would also have the ability or the option to roll the balances into what's called an inherited IRA, which would basically give him a choice of either distributing all the money from the plan within 5 years or doing it based on life expectancy, so similar to an RMD type of a situation. So again, that would either of those would require immediate distribution. So, or distribution within 5 years or immediate distribution. So if she were to leave the balance to somebody else, then they would be required to either do a full distribution within 5 years or receive a portion of the funds on an annual basis based on their life expectancy. So it's a little bit less flexible when the funds are inherited by somebody that's non-spousal because they are basically required to either take all the money out and be taxed on it in that year or begin taking small distributions throughout their lifetime. So that's something, to make a decision on, when you start thinking about who you're going to give the money to, as time goes on. So the next topic, minimize estate taxes due. Currently, each spouse has an estate tax exemption of $5.25 million, and each of your exemptions is portable. So what all this means is that when you pass away, there is an estate tax that will be due on any balance above a certain point. You're exempt on your first $5.25 million on paying estate tax. What portable means is that if you become deceased and you want your estate tax to carry over to your spouse, you can actually transfer that amount to your spouse. And so, effectively your spouse's, exemption increases from 5.25 to $10.5 million. Now, something that doesn't just happen on its own. You actually have to elect that on the state tax return. But that's something that certainly should be taken advantage of, especially in your situation where, you'll most likely be impacted by that estate tax, unless for, over the next few years it's increased pretty dramatically. So, um, one way to, so that's one way to get started. We can protect the first $10.5 million, and we can't control what the government does, but for today's purposes, we'll protect the first $10.5 million. Anything beyond that, there are strategies that you can employ that will, allow you to, actually accomplish some of the other things you had mentioned too, such as gifting to charity, gifting to family members. It'll allow you to basically get those assets out of your estate, and hence reduce the estate tax due on them. So one of the things you mentioned was you wanted to fund the grandchildren's education. A great way of doing this, is through a 529 plan. Essentially, a 529 plan, it's similar to an IRA, in the sense that the money goes into the plan, grows on a tax-deferred basis. The difference is, if the funds are pulled from that plan and used for higher education, then they won't actually be taxed at all. So, as long as the funds are used for higher education, then they'll be distributed on a tax-free basis. The nice thing about these plans is that you can gift in advance as well. Right now, there's an annual exclusion of $14,000. Now, what you can do with the 529 plan is actually gift for 5 years, making it a $70,000 contribution for each child. And each parent can actually contribute to each child too. So you can actually contribute quite a bit of money and almost fund the entire education in a matter of a couple of years, without using up any of your gift exclusions, and getting that money out of your estate at the same time. Now, if God forbid something were to happen to you and you were to come deceased before that 5-year period of time was up, then some of that could actually be called back into your estate. But for the most part, this is a great strategy of not only getting the money out of your estate, but funding someone's education as well. So we could talk a little bit more about that a different day. Um, we identified a few of the candidates for this program. That would be Javier, that would be Leandro, Leah, Emilio, and Yana's unborn child. And so right now the cost of tuition at a public school is about $29,000. That's at a state school. Assuming all your grandchildren start school when they're 18 years old, and the cost of college continues to increase by our assumption of 6%. Just to give you an idea of an approximate amount for fund the first year of college would be for Javier would be about $65,000. Amelia would be about $70,000. Leandro about 73, and the unborn child would be about 83. So just to give you an idea of how fast prices move up, funding this plan well in advance, like you're considering doing, can actually really help you combat this rising cost. Okay, so one of your other goals was to gift $1 million to charity. As you mentioned, you specifically wanted to give to charity, receive income from the property gifted during your lifetime, and allow the property to pass to charity at death, and still receive a charitable deduction at the time of the gift. You also specified you'd like to be able to add more funds, if your financial situation warrants. So there are several methods of doing this. One of the methods is called the Charitable Remainder Trust. Charitable Remainder Trust would allow you to, within limitations, accomplish the requirements listed above. It would allow you to remove property from your estate. But it would note that there are some phase outs for AGI limitations on the tax deduction you could take based on the type of charity that it's donated to. So that's something to consider as well. We consider some other methods. A CRUD is another. A CRAT is another method as well. The reason we didn't choose the other methods is because they weren't quite as specifically tailored to what you're trying to do, such as being able to add more in a future date, and indexing for inflation. So another goal that you had was gifting to children and grandchildren without increasing your tax liability and using up exemptions. Um, One great way to do this is through what's called a family limited partnership. This is an important tool to help kind of freeze the value of the funds that you put into the partnership, and gift them to your children and grandchildren without being immediately taxed at that point in time. And you can also do this without using up your lifetime exemptions by basically coming up with a plan that would only give a certain portion to each family member. So basically what you do is take a minority interest in a partnership with your family, and you would take advantage of some valuation discounts too, because of the business having a lack of marketability. So basically, because that stock isn't easily sold on the open market, the government will actually allow you to take a reduced price of that stock in order to contribute it to the family limited partnership. So you can, in some cases, reduce it up to 35 to 50%. So as long as we coordinate gifting to a family limited partnership with other interfamily gifts to same individuals, we can actually minimize the possibility of using up these lifetime exemptions. So one possible concern with the strategy is it does not create marketability or liquidity to those closely held shares. So they go into the partnership, but it doesn't necessarily mean that it's going to be easy to sell those shares when you want to do the distribution from the partnership. That's one challenge that will be, it'll be certainly a challenge to overcome that. Another is that these types of plans, they tend to be expensive to set up and administer. It would require some additional estate planning professionals, to be highly specialized in that area to become involved. So, but certainly something to consider. Another is to establish an irrevocable life insurance trust. Because the proceeds can be received on a tax-free basis. Certain types of trusts are not considered to be part of your estate. Purchasing life insurance inside this type of a trust will not only remove the value of the premiums of purchased for the insurance from your estate, but the proceeds would go to the beneficiary on a tax-free basis. So there are certainly a lot of limitations involved. You can't have a lot of control over the insurance. You can't have ownership over the insurance, otherwise it will get called back into your state. But as long as you can set it up in a fashion that would, limit your involvement with it, then it would be, it would be excluded from your estate. And the best way to do that is through the form of an irrevocable trust. So again, another concern with the strategy is that you'd mentioned that Dario's health is not the greatest, and so again, we would explore this. Wouldn't guarantee that it would be an option that would be available, but it would certainly be worth considering. So, okay, another area of concern, you want to begin gifting to children and grandchildren, allowing the children to begin to enjoy the gifts now and the grandchildren to be able to enjoy them at the age of majority. So this relates to another concern you mentioned, and that's ensuring that Dario's remaining assets go to the grandchildren after he and Anna are deceased, not allowing Anna to make changes, and vice versa. So in a nutshell, putting together, an irrevocable trust would be a great way to do this. One thing to be concerned about, though, is generation skipping tax, which would be applicable to gifts over the annual exemption amount on gifts given to grandchildren. And in this case, it'd be made drafting plans separately for them. Both plans would take the form of an irrevocable trust in order to remove the assets from your estate. The trust would be established in the name of the children. The property would begin to be placed in the trust within those exemption limits. Again, that's to avoid using up your lifetime exemption for gifts. Once again, closely held property would qualify for a discount. The trust would be set up to pay out income generated. So again, you wanted your children to be able to enjoy, now, while the income could be paid out to them at this point in time. A method to consider for gifting to grandchildren would be through the form of what's called a dynasty trust. This type of plan avoids generation skipping tax, and it also would pass to the grandchildren on a tax-free basis once the terms of the trust allow. So this type of trust would also be managed by a trustee or a fiduciary, such as a bank, that would remove the burden of responsibility from your family as well. So as long as you can find a fiduciary that you trust, this would be a good way to kind of relieve yourself of some of that responsibility as well. So next topic, begin transferring commercial real estate to children without receiving consideration and minimal tax liabilities. If you sell a property for less than its fair market value, it's called a bargain sale, which means that it could pose as income, earned by one or a taxable event. So you want to try to avoid doing that. One way of doing this is to place the property inside a trust. What that would do is essentially freeze the value of the property today. Okay, and so while that value continues to appreciate, what would be considered in your estate would be frozen. Then you can begin to gift that property over a period of time to the kids. So another topic was to provide lifetime income to Anna and access to principal if she needed it. So an important consideration is providing income. For example, if you were to take 70% of your current income during retirement, again, it's about $940,000 by the 20th year, you'd be required to increase your income to approximately $1.7 million to maintain the standard of living. So inflation is certainly a key thing to consider here. There are several methods available to provide lifetime income. Because of your circumstances, we generally recommend a tax-efficient portfolio that would basically consist mostly of tax-free bonds and tax-deferred instruments to hedge for inflation. This would allow you to not only continue to grow your principal amount, but take some tax-efficient distributions from the plan as well. One of the major risks to this type of plan, though, would be you'd have a lot of concentration in a fixed income portfolio that would be susceptible to a lot of political risk. So that's something to consider. Discuss the implications of downsizing their home as well as the implication of selling their vacation home. Nice thing is that there is an exclusion of up to $500,000 on the sale of a personal residence, assuming you've lived in that residence for 2 of the past 5 years. In your case, I believe that you have. So that means when you sell your property, at least $500,000 will be excluded from the gain. Any gain beyond that, between the exclusion and your adjusted basis, would be essentially a long-term capital gain. So that would be something to consider. At least you get favorable rates on that, but it would still create a taxable event. Implication of land ownership in another state and how to keep it in the family for several more years, anticipating its appreciation. Similar to what we talked about earlier, if you expect this land to appreciate significantly in value, you're going to want to try to freeze the value for estate purposes. If you can put this land into a trust, let it appreciate outside of your estate, and so when you begin gifting this to the rest of your family, it'll minimize any estate tax ramifications. You also want to consider a plan that would allow Amelia to purchase land through an installment sale while continuing to maintain control over the land and have the payments cancel at Dario's death. This is essentially the definition of self-canceling installment note. Essentially how this works is there's a table that's used based on age that they come up with to determine what the payment should be. Basically, it works out to during that life expectancy, the person's life expectancy, the note ends. The benefit to this plan is that if the person giving the note becomes deceased before those payments have finished, the remaining payments are actually canceled. So this is kind of a bittersweet thing, but if Dario's health is not that great, if he was to die before his life expectancy, there's a good chance that these payments won't actually be made in full, and they would actually become forgiven. So so that brings me to the conclusion of what was identified. A couple of other areas of opportunity that we found in addition. We noticed that there were some estate planning documents that needed to be updated, such as reviewing your wills, property titling, a personal letter of instruction, incapacity planning, etc. Also, one of the major things we noticed is that beneficiaries certainly need to be updated as well. Another opportunity we found was insurance coverage. Life insurance, there's certainly a shortfall there. There wasn't any disability insurance discussed. Um, Disability insurance would certainly be important given the level of income that would need to be replaced if, God forbid, something were to happen. Um, we did notice a shortfall in the homeowners insurance as well. Um, Long-term care. Now, this is, it's not too late to purchase this. However, it would have been, probably a lot less expensive to purchase it, you know, 20, 30 years ago. But this can actually become a huge drain on someone's estate because just of the huge amount of cost of long-term care, the rising cost, and people's life expectancy becoming increased. So we also noticed an opportunity with your watercraft insurance. We would we would take a look at that as well. Um, we would also consider an umbrella policy. And what an umbrella policy would do would essentially anything above and beyond your maximum level of coverage now, it would cover that, anything beyond that. So basically what we would do is create an umbrella policy that would equal essentially the amount of your estate. So if God forbid there was a huge liability issue that came up, something to that effect, your estate would still be covered. Another opportunity that we discovered was, we really didn't see any clear retirement goals for income that were stated. And so, while you have certainly the means to provide a significant amount of income in retirement, it's good to come up with a plan that would, give us some framework as to where to go. Come up with a target amount of income. As mentioned earlier, you certainly have a significant amount of discretionary income at this point. So maybe your income goal would be less than what you're currently earning, but it would be good to come up with a number there. Another opportunity we found were IRA contributions. Even though you can't deduct these contributions, the money going into the IRAs will still grow on a tax-deferred basis. So it's another way that you can continue to, increase your tax-deferred savings. A tax-deferred annuity, again, another opportunity to increase your tax-deferred savings. Money in an annuity is not taxed until you pull it out. So it would grow on a tax-deferred basis for you as well. So that essentially concludes that portion of this presentation. I would say in closure, there were a few things that did come up during the course of our conversation with you and your partner Wendell that we felt it was important to disclose. There is the possibility of a conflict of interest existing. We do have an ongoing relationship with Wendell and had potentially disclosed some information to you that was confidential and outside of what would be appropriate. And so we just wanted to make you informed of that and just be in full disclosure there. So that concludes my presentation, and I hope you enjoyed it.